and welcome to session 4 of Cosmo Talks, powered by NESCAFÉ Gold. Today we're talking about the importance of financial literacy and how you can make smart money moves. To speak with us today, let me introduce our panelists. We have Lakshini Fernando. She is a senior research analyst and economist at Securities, which provides a comprehensive suite of financial and investment solutions in Sri Lanka. She has over 13 years of capital markets research and primarily manages the macroeconomics, product, and overall product management at Securities Research. Prior to this, she was a senior associate quantitative services at Equity Knowledge Partners. Then we have Bimanee Meepagala, has over 15 years of experience in capital markets. She's currently the Chief Bancassurance Officer at Union Assurance. Prior to joining Union Assurance PLC, Bimanee served as Vice President at NDB Wealth Management Limited. She is a fellow member of the Chartered Institute of Management Accountants and a member of Chartered Global Management Accountant. Thank you so much for being here, ladies, and for taking the time to speak about this topic. To dive right in, surveys conducted indicate that Sri Lanka has a financial literacy rate of about 35%. But for each of you, why is financial literacy so important?
So yeah, can I go first then? So first and foremost, thank you, Shem, for organizing this. I think it's the much needed topic that needs to be talked about. So thanks for organizing this and for having us on the panel as well. And like you quite rightly said, I mean, we have a literacy rate of about 92%, but when it comes to financial literacy, that comes down to 35%. You compare that with the developed countries, which have a literacy rate of about 65%, right? And just to put set the stage right, I mean, if you look at Sri Lanka, we have one of the highest number of financial accounts that have been opened per person. So 74% of Sri Lankans have opened a bank account. So that tells us that, you know, it's not the access to financial products, financial institutions, that's the problem. It's all to do with the lack of knowledge of financial literacy. So when you have access to banks, why financial literacy is important is because you need to know how best you can utilize that access, what you can do to make your money work a little better than what it, you know, can just sitting at home. And you can also make really smart decisions at the end of the day. I mean, especially in this current environment, if you know a little bit about how you can sort of allocate money, for example, when interest rates are really low, that would take you really far, you know, rather than keeping your money in a fixed deposit, for example. So it's decisions like this and making this right and smart decisions to make your money work a little bit better for me is why you need a higher level of financial literacy.
Thank you, Lakshmi.
So so essentially elaborating from where Lakshi stopped, I'll give you like a very contemporary example right now. So now you hear most of the consumers complaining that the interest rates are low and you're getting like single digit rates on your fixed deposit. But if in case you are financially literate, not so long ago that we had double digit interest rates. It was in even government securities, so that's essentially risk-free. We call them like zero risk investments. Government securities were double digit. Then if in case you had like enhanced risk appetite in terms of fixed deposits or even debentures, you had double digit interest rates, right? But essentially what happens is our deposit holders, or as in like if I put the pool together as consumers, our consumers are essentially very short term, like they will be looking at 3, 6 or 1 year, right? But let's say you had if you were financially literate enough and you went and locked in 10% or 20% in a 5-year fixed deposit, or like a 5-year debenture, instead of going for a 3 months, 6 months or 1 year, which will be renewed at very short frequencies, you would have actually been better off despite interest rates coming down, right? Because despite the interest rates coming down to single digit level, your investments would have been locked in for a 5-year at double digit rates. Okay, so the other reason why I would impress upon why financial literacy is important is that there is a concept of inflation, or what we say is that prices of goods going up, right? So the rupee that is valuable, a rupee today is less valuable tomorrow because prices of goods are going to go up, right? So you need to financially plan yourself. Let's say if you want to send your kid to Ivy League school today, let's assume you wanted 10 million. If I need the money in 10 years time, this 10 million is going to be worthless and my kid will not be able to go to an Ivy League university. So you need to understand that first and foremost. If not, it's going to be you are going to get into trouble. Okay, and then the other thing is, if you're financially literate, you plan yourself much better, that you don't add on more and more debt, right? So we'll talk about that when we go forward. But if in case you are not financially literate, you are going to swipe your credit card more often than what you should, and you are going to be in a deficit scenario. The other thing is, like, let's say if in case I am knowledgeable, like as a mother, if I am financially literate, I can, from the very small days, I can sort of impart that knowledge on my kids so that they are financially disciplined from the small days as a family, one whole unit that we plan together. And that is a good inculcation that we can bring up to the society, that from generation to generation we have financial discipline, right? And also, I think one of the more critical things is, yes, sometimes we don't really look at the bottom of the pyramid, right? So for example, what I would say is, in terms of you have to go through a critical surgery or hospitalization, you know that those are not cheap, right? But if in case you are financially savvy and you had like some basic insurance, you don't have to dip into your savings or current account or even uplift your fixed deposit. You can simply get the insurance to pay off, so where your money is intact. So that is like another thing where, if in terms of emergency, you don't really utilize all your resources in terms of in times of tough times in life. And also, yeah, say, let's, for example, let's say if you're financially literate and you're a person who's working, or you're just doing some business, but if in case you feel that one source of income is not sufficient, let's say for a full-time person who's working, you can go in for another source of income. So that also you have to have the knowledge to understand that you need to pick up another job, right? And also, like, finally, when, if in case you've done your financial planning well, so you come to self-actualization, that's when you can really do charity and do better for the society itself. So that's why I think, as a community, we should really look at financial literacy. And I think I really welcome this conversation, because this is not often spoken about, but I think it's very critical, given the aging population in Sri Lanka, that we pick up topics like this and we educate our population.
Absolutely. And money is such a topic that is off limits in a lot of households here. Families don't really take the time to explain things like investments and savings and loans. Why do you think that is, and how do you think we can start changing that narrative at home? Lakshini?
Look, you're right. I think what I see is this, right? I see the concept of savings being spoken about a lot. I mean, even when we were small, we were always given a till, we put our change money in there. That concept of saving has been spoken about, and it continues to be spoken about as well. But what's not spoken about is the concept of investing. What's not been spoken about is how you save, how much you save, how do you determine, how much you save. And like Bimanee said, you will come to situations where, all of a sudden you'll need X amount of money, and you realize, wait, I don't have a savings. I can't pull out my fixed deposit because that's not enough. Because when these emergencies come, it comes in millions, right? It doesn't come in small numbers. So it's a concept of how you prepare for situations like this that is not spoken about. And to me, what I like is that I see things gradually changing with my generation, because with my parents, I wouldn't say that it was spoken about that much. But I see it also comes from this cultural scenario, right, where you don't really talk too much about money. It's not a concept where you share details about, and that to me is one of the biggest issues that you're seeing. And I think it's very inviting that partners now, even before they get married, they talk about these things, talking about, what, I mean, these are difficult conversations, but I'm really glad that people are having it. I'm really glad to hear that some of my friends have had these conversations. How much of debt do you have? How do you use your credit cards? How do you manage your lifestyle? I mean, so many times, even when we talk, we're like, wait, how do these guys, how do they manage this lifestyle? That is a question that we've continuously kept, coming. And questions like that need to be answered at home more than anything else. It has to be realistic, where you sort of sit your children down and you make them understand. Because to me, a part of financial literacy is also figuring out how you live within your means as well. And that is a very important concept that needs to be told at home. And it has to start somewhere. It has to start literally now, where you talk about it with your partners, you talk about it with your kids, you instill those habits, and it has to happen as an example. And to me, I feel if parents start doing it, if parents openly talk about things like, credit card issues, investments, how do you make your money work better? Your kids also sort of adhere to it, and they sort of see, okay, this is what's been happening with our family, and they seem to be doing things okay, so I guess I should be doing the same. I mean, that type of mentality is what I think is evolving, and I'm really glad to see that it's improving from my parents' generation to now. Bimanee, I'm sure you have something to add on as well.
Yeah, so definitely like what you say, Lakshmi, like if you look at like historically, if I look at the Sri Lankan society particularly, it was the father who was running the show. He was the one who was bringing the money. So he would have given some money to the mother to run the household. That was like history. But with more women joining the labor force, we are increasingly seeing that both parties bring together the money to the table and basically split the bills in terms of how we pay the mortgages and how the expenses are paid. Now, for example, even at my place, of course, we are very open about it, and we have like a split. I mean, our bills are essentially like the household expenses are split, so we know exactly the expenses that my husband has to bear. I know the expenses that I need to bear, so that we have that open discussion. I think that's very important, and especially this open discussion is very important, in fact, because to avoid a lot of frustrations in the future. Let's say like you see the Sri Lankan society, we live beyond our means without a doubt, right? So I mean, if in case you are open about the problems and your incomes, you are not going to like push the other partner. Let's say it can be the husband, it can be the wife, to like go on exotic holidays or to buy the latest type of Merc. That is not going to be there if in case you're open and you understand each other. And especially even for kids, you don't like, if in case you can't afford, if in case you can't really send your kid to Ivy League school, you tell that from that time, this is what I could do. So the expectation management also happens. So I think that's really important, that you really sort of speak very openly, that like you manage expectations, so that there is no frustration in relationships and families, that you know what is your income, you know your payouts, so you live within your means. And the other real important thing is, when parents are financially disciplined, what I've seen is that like generation to generation that gets passed down. So I mean, I would say like personally, my experience is my father is one of the most financially astute people. So I think though I was a professional fund manager, I think that kind of basic understanding is there in me. And obviously, like when it comes to expenses, I really tell my son, this is what you get and this is what you don't get. So he knows what to ask, what not to ask. So I think those boundaries are there when you are open and you have that open discussion.
Thank you, Bimanee. You're so right. And being financially literate also means having an understanding of like core areas like budgeting, as you said, and setting financial goals, splitting those bills, saving money, understanding the basics of loans, credit cards, and even how investment works. And the whole topic can be kind of overwhelming for many people. But do you have any first steps that people can take towards becoming more aware of their finances and setting these financial goals?
Yeah, so I think, look, I think first and foremost, what you need to do is, yeah, it is overwhelming, but it, you know, when you actually break it down, it really isn't. And there are some really simple things that you can do and what everyone really should be doing. How I would really go about it is, I think everyone should have something called a personal budget. And this is something that, you know, some people know about, they do it religiously. But some actually really don't. I mean, even when I talk to some of my colleagues and my friends, you know, who have been working in, you know, certain industries for 10 plus years, even you talk to them, they still don't really have a budget. And I'm like, well, if you have this conversation where you say, look, do you know how much you spend in a month's time, I can guarantee you that 5 out of 10 people would say, no, I don't really know. I have an idea about it, but I'm not really sure how much I spend every month. So first and foremost, you need to understand how much you earn. Now, for some people, it's really easy because it's your salary that comes in, but for others, it's not. I mean, there are certain people who do freelance work, who do, you know, different types, 1 or 2, 3 jobs, you know, so you need to understand how much you earn in a certain month. Once you figure that out, right, you need to see what your biggest top tier expenses are. So your top tier expenses are your essentials, your fixed expenses like your rent, your utility bills, which you have to pay, things like your loan payments. You need to understand how much you have to set off for those payments every month. And then you, of course, keep a certain, you know, very manageable amount aside for your savings. You have to start off small. Everyone gets really sort of, you know, gets driven away by saving because what one question, at least one answer that I've got for this is, look, no matter how much you save, when an emergency comes, it's not enough. But that is all to do with how you make your savings work as well. You don't really keep your money in a savings account, right? You make sure that your savings are utilized properly, that it grows properly. So coming back to this, I mean, you need to understand what your core expenses are every month. And then you set aside a certain amount of money for your variable expenses, because you do have, you know, you do need to spend money going out, you know, ordering out, things like this. But that is also an area where you can understand as to how you can cut down on, because the difference between your top tier expenses and your second tier expenses will really tell you where your money is going, because this is something a lot of people don't know. Numerous times, you know, at the end of the month, everyone's like, gosh, I don't know where my money's gone. I'm just waiting for my salary to come in. I've heard this so many times. And that is essentially because you don't know where your money has gone. So you need to get a very good idea as to, you know, where your money is going, where you can really cut down from as well, if that is the case. Once you actually take a pen and paper, you write it down, things become that much clearer, and it does not become overwhelming, because then you have an understanding as to where most of your expenses are going. If you are then living beyond your means, beyond your income, that means you're using your credit cards a lot more than what you should. You know, you're depending on other means of borrowing to continue your lifestyle. And that is where you really need to ensure that you sort of curtail back a little bit. You make some very tough decisions, but also you become financially independent. This is one of the biggest advices I can give. It's one of the most important ones, because being financially independent is the most important thing. And it's really good to see, especially a lot more women are becoming very financially independent. And it's great to see, because you've seen over history, and it's a statistically proven thing that women, you know, manage money better. It's all to do with how you plan things, how you prioritize your expenses, and how you ensure that you do leave something for your savings. We can get into how you make your savings work better a little bit later, but essentially, to me, this is your starting point. You have to have a personal budget. You have to allocate a certain amount for your savings, depending on what you want to do with those savings. And you need to see where your, you know, big expenses, where your unnecessary expenses are, and you need to start cutting down a little bit there if needed.
Yeah, Lakshmi, I can't agree with you more. I think really everybody needs to be financially independent. And like for me, this formula is very simple. to start saving, you need to start somewhere, right? So my advice to everybody is your savings is essentially your income minus savings is expenditure. It's not the other way around. It's not income minus expenditure is not saving. So you know when your salary hits the account, you know, let's say it doesn't really matter because we have to start somewhere. It could be 1,000, it could be 5,000, it could be 1,000,000, but you need to have that discipline where automatically when your money comes, you have to swipe some money for savings or investments. That is a must, because if you don't do that, like what Lakshi says, you will do discretionary spending and you will finish your income, let's say in 2.5 weeks, and then you're on your credit card for the next 1.5 weeks or so to live with. So obviously that discipline, if you don't, as soon as your salary hits the account, you don't put aside some money, you're never going to start. So I think that's a very tough thing. It will involve lifestyle changes, like what Lakshi correctly mentioned out. Let's say if in case you're eating out 4 times a week, now you might have to cut down to 2. Yes, let's make that call, but it is a call. It's the first step that you need to take to start your savings investment journey and to be financially more independent and financially like to be very stable. Yeah, so that's what I think.
Thank you, ladies. Circling back to a little bit about saving specifically, and then we can kind of delve into investments a little later on. What tips could you offer young people when they are starting their savings journey? Well, elaborate a little bit more on it from where you already did.
Look, to me,
Shall I pick it? Yeah, sure.
Yeah, go for it. Possibly a network issue on her end.
Can I chip in until she comes in? No.
Go for it.
Yeah, so essentially, the start is obviously going to be very difficult, right? So you need to start somewhere. So I think first and foremost, what you need to focus on is that you have your bottom of the pyramid strong. Let's say in a house, you have to have your foundation strong enough so that your house is stable. So same as in financial literacy or financially being savvy, you need to have your bottom of the pyramid very strong. For example, let's say like you have to have, let's say, 3 months equivalent of your salary or 3 months equivalent of your income always. Let's say there could, I mean, if we sort of connect to these days, like during the COVID period, a lot of people had layoffs, a lot of people had salary cuts, but let's say if you had that 3 months buffer, you have 3 months time, even if you had to leave your job, you have 3 months buffer to find a job or to come up with a strategy. So I think having that 3 months contingency buffer is really important. And also, I think I elaborated this point earlier. So also you need to have emergency money. If you don't have that emergency money, you got to have like at least a very basic insurance policy so that it will cover your health and surgical expenses. And let's say in a unfortunate event that there's some lump sum that the family will get. So I think that's like very basic that we need to have. And the other thing is, I think Lakshi sort of touched upon it, but I think we really need to have a budget and also do like a cash flow forecast, right? So as in like when I do, though I use this high financial language, essentially the cash flow forecast is generally, you will know if you look at your the 12 months. I'll take a very simple example. You know, January will be a heavy cash flow month if you have kids who are going to school. So let's say you have the book list coming, school fees coming, shoes, everything is going to be very heavy in January. So obviously you might, let's say if you are having fixed deposits, you might want to make sure some fixed deposits mature in January, or you have some extra money, or let's say if you are invested in coupon paying instrument, that you get some extra money coming in January. So without dipping into your savings, you can make sure that you pay your kids' education. And generally, like I'll take a very simple example because which could be related to Sri Lanka. Like April, generally the Sinhala and Hindu Tamil Sinhala and Tamil New Year is big, and we buy gifts. So obviously that's going to be a cash flow heavy month, right? And then Christmas is another thing. So when you know your cash flow heavy months, let's say for your car insurance can be another example. So that's also going to be a big expense, right? So you can plan your cash flows in such a way that you don't have to sort of take a fixed deposit or swipe your credit card simply to pay your insurance premium or the car insurance, so on and so forth. So I think that's also one of the very important things, right? And then you also really need to have set aside targets, right? Let's say you want, let's say if in case you're young and you want to get married, so you need to have that money without going and borrowing for your wedding, right? If I take more substantial examples, like if you want to send your kid abroad, so you need to make sure that you have enough money, that you have that money in 10 years, 15 years or 20 years time. There's no point stressing yourself at that point in time that you don't have the money. So it's obviously, let's say you have to set that financial goal and work towards it, not simply like saying that you need 25 million in 10 years time, but how you achieve that 25 million in 10 years time, you need to work out, right? So we'll get on to like how you get in there in a little bit. And the other thing is, let's say if in case you feel with a single income, let's say for example you want 25 million in 10 years time and you have only the salary that you get, and you definitely know your salary is not enough. If you have such high aspiration for your kids, then obviously you have to think of a second income, right? It doesn't have to be another job, but then you can do baking, or I've seen a lot of people now getting into fitness training. So you diversify your source of income, right? So you do something, or a lot of people do tuition or lecturing. So you make sure that you have that amount of extra source of income also coming to you to make sure that you are financially stable.
Lakshini, I think you got cut off a little bit earlier, but do you want to come back and answer that question?
Yeah, I know. Sorry about that. But I completely agree with Bimanee. And you know what? The biggest problem, Shyam, is this, right? People have great aspirations, and everyone should, right? If they want their kids to have the best education, they want to go on, the best holidays, which they really should. But if that is the case, they really need to know how to do it. They need to know what decisions you need to make to get there. And I absolutely agree that when it comes to that day, you cannot sit and be like, oh dear, I need 10 million tomorrow, to get this done. When, you had 15 years to think about it. So this is why I say, I mean, even for the younger, generations, it's never too early to save. It's much easier to save at a younger age than it is in your 30s. Because I mean, you don't even have to be married and have a family to have responsibilities in your 30s, for you to move out, for you to be independent. It is that much more expensive, and it is that much more sort of stressful on your income, but as you get older. So when you start off younger and you make your savings work better from then on, you actually are in a much better position than you would have been, in your 30s if you started saving. Because then I've heard so many people say, who are my age, who are saying, look, I've got so many expenses which are crucial. All of them are my top tier expenses. How can I put anything aside? So to be really honest, I think 30s is too late to start saving. You need to start saving earlier. You need to make sure that you have that sort of saving mentality, because once you start doing it, it's actually, it's quite streamlined. You don't even realize it, because for example, I mean, a lot of people I know, as soon as their salary hits the account, they have a standing order where, their money, their savings is sent into a different bank account, and it's not even touched. And that is really how you should make sure how you work your money, and how you make sure that savings happens without even you knowing it.
Completely agree. And in terms of loans and understanding interest rates and how they work, would you say it's always wise to have an understanding of all of that before you actually take on a loan or a credit card, despite what people may say? What are your thoughts?
Oh, absolutely. You should never get into a loan without knowing what you're getting yourself into. But the good thing is this, right? If you go into a licensed financial institution, like a licensed bank and a licensed finance company, I will stress on the finance companies, because that is where, you know, you have certain licensed finance companies and unlicensed finance companies. So they are not regulated. They can literally give you a loan at any rate and without any conditions. And that is where you really fall into a trap, right? I cannot stress enough that anyone who is looking out to get a loan to go to a registered financial institution. And when you do go to a registered financial institution, the good thing is they do such a thorough background check on you to ensure that you can repay the loan that they are giving, because it's in their interest, that if you actually cannot afford it, they will not give it to you. It's as simple as that, you know. But if you go to, you know, these unregistered financial institutions, especially loan sharks, that is where you really fall into trouble, because I mean, there are certain institutions that even have as high interest rates as 10% a month, whereas now you can get loans at 9% per annum, you know, and those are fixed rates. And you go to a loan shark, you go to these unregulated institutions, they're not governed by anyone, right? You have to really have a very good understanding of what you're getting into, how much you can allocate for a loan. And I would really like to mention this as well, right? A lot of people see credit cards in a bad way. Credit cards are not bad. Let me tell you that. It's how you use a credit card that's good or bad. Credit cards and even loans. I mean, even some people say loans are really bad, but to me, look, by having access to a loan, you can actually meet certain aspirations, like getting a higher education, buying a vehicle, if you can actually afford it, right? And so it all depends on how you manage your loan and how you manage your credit card. You do not take out a loan, like Bimanee said, you do not take out a loan to go on holiday. You do not take out a loan to, you know, for anything that's non-essential. If you say you'd use a loan to buy an asset that you can actually sell later on, that's an investment there. Say you buy a vehicle today, you sell it in 5 years, you still get a return, right? You take a loan out for $1 million, you go on holiday, what return are you going to get? You know, that's your mentality that you really need to think about. You need to understand how loans work, what the tenure is, you know, how much you can pay off every month, if you can afford it or not. And this is where having a personal budget helps, because if you are going into a loan, you will actually have an understanding as to how much you can actually allocate for that repayment. And the good thing is, you know, banks are that streamlined, where they will ensure that you can actually meet the repayment if they are giving out a loan. So I cannot stress enough that you need to understand how to use a loan and how to use a credit card, and how you need to understand if you can actually afford it or not.
Yeah, so like what Lakshmi explained, so I will not really look at the unregulated financial sector because Lakshmi essentially touched on it. So for me, loans are essentially not bad things, right? So it's how you, the purpose of why you take the loan, right? So I mean, right now, I think everybody needs to rush to the nearest bank and borrow because rates are at single-digit levels, and it's like one of the lowest that we've seen in the history of Sri Lanka. Okay, so not so long ago, we were still borrowing at double-digit levels, and if in case you go 10, 20 years, or maybe not even, yeah, maybe 10 years back, if you look at the history, we were borrowing at about 20% plus. Right, but still people were borrowing and businesses were happening. So like what Lakshmi explained, I would like to elaborate. Let's say even if you borrow at 10 and you are sure, like let's say the asset that you are going to acquire, let's say you buy a house, and that house you can sell it, let's say you at 10%, but you can sell it at a return of 25%. Obviously that borrowing is substantiated, right? So you get a 15% return simply because you borrowed. If you didn't go to the bank and do that borrowing, obviously you're not going to make that additional 15%. So borrowings are always not a bad thing. Like what Lakshmi explained, I think it's why you borrow and for what purpose you borrow. And like again, if in case you do your budgets and 50% or more of your income is paid for the banks, again that's wrong, right? It's not sustainable. So you really need to look at the critical, you need to take a critical look at why you're borrowing and take it on. So my advice is, right now interest rates are at very low levels, and I think you, if in case you have projects and businesses that you want to venture into, that these are going to be these are actually very good rates, if provided that you can make sure that you can repay the loan and make a gain, right? So let's say you want to start your own enterprise, or just do a baking business, or get into agriculture. So borrowing at these rates, making sure that you can do more than 9%, because that's the borrowing rates right now. Let's say even if you can get 15%, that is some money that you're generating which you couldn't have done if not for borrowing, right? So it's like so it's a very calculated call that you make, that how much more can you make out of the money that you borrow.
I want to kind of circle back a little bit.
And if I can just add on to that. I mean, like Bimanee said, these are historically low rates that we are seeing, right? We've not seen 9% rates in the history, okay? And these are fixed rates. That's what you need to make sure as well, because financial institutions two options, right? To have your rates on a fixed rate or a flexible rate. So flexible rate means it moves in line with the market interest rates. But the fact that banks are offering fixed 5-year rates at 9% is unprecedented. And it is absolutely essential for anyone who has the need. I mean, not for everyone to just go run to a bank and get a loan, but anyone who has the need to actually use these, because in 5 years' time, I can guarantee you that rates are going to be higher than 9%. In 2 years, rates are probably going to be higher than 9%. So, you know, it's an absolutely essential time. And this is where financial literacy comes into play, right? When you see, if you see like a billboard, if you see, anything that says that banks are giving rates at a certain percent, you need to understand what that means. You need to understand if that's a good thing or a bad thing, if, you know, and I mean, there are people who can help you understand, help you understand that as well. And I think we'll talk about that later as well. But it's crucial that you ask the questions, that you keep asking the questions. Is it the right time? Is it the right decision? Can I afford it more than anything else? Those are the questions that you really need to ask.
You mentioned a little while earlier about unregistered financial institutions. Is it a common practice for people to go to places like that?
Yeah, Shyam. So basically the thing is this, right? Unregistered financial institutions are relatively easier for you to get a loan from, because the paperwork is less. They require less sort of, I mean, if, for example, if you go to a bank and ask for a loan, they will need so much of information from you. They'll need 3 months worth of your bank statements. They will need a letter from a company. They will need to know how much your salary is. They will need to know so much. They will literally do a very thorough check, whereas unregistered financial institutions do not necessarily do that. They will give you a loan very easily, but they will also ensure that you repay that loan, right? So a lot of the sort of unregulated financial institutions, what they do is they give you a loan on using a collateral. So you basically have to back it with, say, property, with a vehicle, with something that they can, sort of take if by chance you stop paying. And that is essentially what has happened. I mean, you know, you've heard so many stories of properties literally being taken up because you have not met your repayments, you know. So it's things like that you really need to. I mean, banks will do the same thing. Don't get me wrong. Banks also give collateral-backed loans. And if you do not make that repayment, they will also take it back. But it's just that unregulated financial institutions, even if, say, something happens, you're not covered through regulations. You cannot get any help from any institution because they're not regulated. And that's essentially the difference.
Got it. When it comes to investment or retirement options, what should young people actually consider when diving into something like that?
Look, retirement again is not something you need to think about when you're 40. It's not something you need to think about, you know, later on in life. If you want to have a stress-free, good retirement life, you really need to think about it sooner rather than later and start allocating it in a separate fund. So this is not your savings, right? See, a lot of people, they have one savings and they're like, okay, I'm going to use this for everything. Really not the case, okay? You've really got to have your emergency fund separate to your savings, and you have to have your retirement separately as well. And these are three main sort of areas that I would say you need to look into in terms of making sure you're very safe. You have a very good safety net for any emergencies. And I mean, if you're looking at retirement, it's a very long-term plan, right? So you're looking at it 30 years from now, for a very long period. And for that, you actually have much more options than you have for short-term investments. You've got wealth planners who can help you sort of make sure that you utilize that money that you put out, that you separate on a monthly basis for your retirement, that you have wealth planners who can help you allocate that more efficiently because you're on a longer time period. So you do have, you do have to think about things like that, and you have to make sure that you get the correct advice as well. Because there are people who keep money in a savings account and they say, okay, this is my retirement money. You probably get what, 4.5% in a savings account these days, where your inflation is 5% plus. So you're actually losing money. So you have to make sure that you make the right decisions and you allocate that money correctly. And that's where financial literacy, understanding a little bit more about what options you have available, comes into play.
Yeah, so adding on to what Lakshi also said, so like we should not be having one pool for everything, for emergency, for retirement, for kids' education, for everything. So we really need to sort of dissect and have separate funds, right? And also, especially like what Lakshi went on to elaborate, if you look at your retirement and based on your age, let's say I have 20 years or 25 years for retirement, I can take some extra risk over a 20-year period. But let's say if I'm let's say 54, you can't risk too much of your money because you know that you're closing on for retirement, right? But let's say at the age of 20, I can some part of, based on your risk return, obviously you can look at some equity investments, right? You can do some amount of trading, let's say in government bonds or get into corporate debt kind of thing. So not really looking at the normal savings, fixed deposits kind of thing. There are other instruments that we can use. So I think that's where there is a huge knowledge gap, where people in Sri Lanka think savings and investments are going to a bank and depositing, opening a current account or a savings account, and maybe slightly sophistication will be fixed deposit, right?
Yeah.
But there is a world out there more than your savings and fixed deposit trade. Yes, you need to have those very basic. That's why I said you really need to focus on the bottom of the pyramid. But obviously you have to understand that risk and return, right? So obviously you will, when you have very low risk, let's say you go and invest in a fixed deposit, there is very low risk because the bank, I mean, if in case you go and invest in a bank, for example, the bank is bound to repay you, right? So obviously you're taking a very low risk. To compensate that risk that you're taking, you'll be paid a very low return. So right now, let's say a 1-year fixed deposit will pay 5%. But if in case you were invested in the stock market in the last couple of months, you would have got in excess of 20%, right? So obviously, of course, there is a risk investing in the stock market, but if in case you made the right call, invested in the right counters, you would have made exponential gain than investing in a fixed deposit, where for a 1 year you would have got for a 1 year you would have got 5%, but in stock market, Lakshi, you are more hands-on, you would have got 20% in a day. I'm not saying to
I would say 30% plus actually.
So I think so if in case you made the right call,
Yeah.
you would have made that type of substantial gain for a day, right?
Yeah.
So that's where you need financial risk literacy. Look at more products and based on your risk return, make sure that you allocate some money. Let's say you have 100,000 and you have like 20-25 years for retirement. Putting 20% of that money, which is like about 20,000 in the stock market, will not do any harm to you, right? So that's like a risk return. We call allocation decision, where you have some emergency money, some money in risky assets, and then you have like very safe investments. So you can look at your asset allocation in that sense in order to make sure that your financial goals are achieved. So also you have to be realistic and practical. You can't, like what Lakshi says, you can't invest so much at 2 to 3% get that financial objective, you can't have plain vanilla products and expect those sophisticated returns. So obviously, sophistication comes with risk, and you need to take a calculated risk to achieve your financial objectives.
And are there any financial management tools that can be used in Sri Lanka?
Financial management tools, is it?
Yes.
Okay, not really. I mean, that's one area that we are lacking in Sri Lanka. But the good thing is, both the government and the private sector are actually, they are aware, and they're actually looking into the fact that financial literacy, the availability of, enhancing financial knowledge is a big area. And actually, I mean, Asia Securities, for example, where we are actually in the process of launching a financial literacy initiative, which is a free trilingual, web-based sort of platform that we are planning on launching under the name Danamaga very soon. So just keep an eye out for that as well. It's stuff like this. I mean, it's a first private sector type of initiative that's been taken place. So, and that is coming in place of these, the lack of sort of financial management tools that are there, because you do need to understand, and you do need to sort of do your own sort of, searching in terms of what works for you. Because see, at the end of the day, like Bimanee said, right, it all depends on your risk appetite. You can be a very risk averse person. If you are, that's perfectly fine. But you still have instruments other than a fixed deposit, right? You have things like debentures from A-rated companies that you can invest into. You've got money market funds. You have other products for even someone who doesn't want to take any risk. For someone who is a little bit, who likes to take a little bit of a risk, I would really say like is the best option at this point of time. But again, you have to have a very good investment advisor who can tell you which stocks to really look at, and not really put into stocks that are run by rumors or financial journalists who don't really know what they're writing about. You really need to understand a little bit more, and the equity market is something that is a little bit more. You need to look at it. You need to have an understanding of it a lot more. So having a very sound investment advisor helps. Because and you need that because there is this area of the availability of products, availability of sort of this educational platform or anything that's there. It's not there basically for anyone who wants to look at it. But like I said, the good thing is that the government as well as the private sector have recognized that this is an area that needs to be looked into.
Yeah, especially because given the aging population in Sri Lanka, we really need to look at financial tools. So like what Lakshmi said, we don't have many, but still we can start somewhere, and we can start for the very low risk appetite type of investor. We have the government bonds, then we have the banks. We have like a range of fixed deposits. Then who wants to take slightly more risk appetite, you have the money market funds, which are more pooled investments, then debentures, corporate papers, equity, and even people can look like foreign currency deposits, investing in foreign currency, then look at property, like gold has been really performing well. So so I mentioned property, which is also like a very hot asset class right now. So actually government is trying to come up with REITs, so where you can invest in property investments as well. So that's like we are in the right direction. So though we don't have a lot of complex sort of tools, we still can do better than what we are doing with the existing asset classes that we have. And I think that's a great initiative. I think both the private sector and the government really needs to take this very seriously, simply because we have a really aging population, that this financial literacy and planning for yourself for the later years is really important. Because if not, the government, if you look at it, we are already running massive deficits, right? So the government also cannot continue to pay these subsidies in terms of pension schemes, or even manage these bloated government hospital, government hospital is a good thing, but then how sustainable is this is going to be a question. So it has to be a gradual sort of transitioning from government to private to some type of mechanism that needs to be there, because if not, that's going to be a politically also very difficult decision. So in order to get to some level, I think financial literacy and investing, this is quite important. So in order to even address like major issues such as the government budget deficit, because we continue to pay huge amounts in terms of pensions, and then like in terms of the government hospitals, and even government education, universities, all of these are going to be costs. I mean, having said that, it's well and good, all of that is there, but I think governments also cannot continue to bloat their balance sheet by providing these subsidies.
Circling back to what Lakshmi also mentioned about financial advice, seeking financial advice, I get the impression that it's not as common, but who can people approach and what kind of questions should they keep in mind when they do?
So again, it depends on what you want to know, right? In terms of how you create your own personal budget, things like that, on a personal, what you need on a personal perspective, I don't know, to my knowledge, if there is anyone who's there to sort of advise. But if you're taking out a loan, if you're taking out a credit card, anything to do with a financial institution, you have relationship managers, right? It's very important to go with a relationship manager who knows the industry, who has been in the industry for a long time. So not necessarily maybe a newcomer who may not really know all the answers. But you can always ask relationship advisors the right questions, and you need to ask them the questions. That's the other biggest thing, right? A lot of people don't really ask too many questions, and it's not that they don't know the questions, it's just that they are probably a little hesitant to ask the questions. Things like, look, if I can't repay, what happens? If I need an extension, can that actually be done by y'all? If I need to restructure my loan, can that be done? Things like, questions like this need to be asked. And I can guarantee you that, mature relationship managers always will have the answers to this. If you're looking at retirement, like Bimanee said, you have wealth managers, you have, advisors who can help you with things like this. If you want access to invest in the stock market, you have investment advisors there again. But I cannot stress enough that you need to go to an investment advisor who's got a good reputation, who has been in the industry for long enough to know, more than what just happened maybe about a year ago. You need to also to go with a financial institution that is very solid as well. Like I said, unregulated financial institutions is a big no-no. Go to the licensed financial institutions, go to the more accredited, stock brokerage companies, for example, who have had a good track record. It's how you choose and who you choose. There are advisors out there. It's just that you need to know where to go to get the correct and more solid advice.
Thanks, Lakshmi. Bimanee, did you have anything to add to that?
Yes. So basically, because Lakshmi went on to elaborate that there is financial sort of advice available, I will just go on to seek some, give some guidance in terms of what questions that need to be asked. Like the first question I would say is, you need to have some understanding about the risk that you are going to take on, right? Let's say, of course, there is there is rating agencies in Sri Lanka. So obviously there are banks which are rated AAA down to investment grade, right? So you need to understand, based on the risk of the different financial institutions, that the rates will also differ, right? A AAA bank may give you let's say 3% because they are solid, right? But let's say if you go to a investment, still a BBB company, which we call an investment grade, will have to pay you something more than 4% in order to attract the money. So you will get, obviously, let's assume in this context 8%. But let's say if you're taking very high risk, in order to attract that money, they'll have to pay higher. So also you need to have that sort of common sense. Let's say if somebody is offering you in this context, when interest rates are at single digit level, if somebody is offering you, let's say 15% for 1 month, obviously that has to ring some bell on you that you are taking some sort of I mean, because it's dodgy, and you have to understand that you are taking some substantial risk. Okay, you might get your 15% in 1 month, or you might lose your capital as well. So that amount of common sense needs to be there. So that's one of the very important questions that you really need to look at, right? And the other thing is returns. Okay, like the other thing that you need to focus on the return. So let's say generally what we say is the higher the risk, the return has to be higher. But let's say if you have to ask what the return is going to be. Like let's say if in case your safe government securities is going to give you 4%, and if you are going to take slightly higher risk in order to get 2%, obviously that investment is not viable, right? So because you are taking higher risk, but your returns are not going to get compensated. The other thing is you need to be focused on the liquidity aspect as well. Sometimes there can be fantastic investment options, right? Let's say for example, you get like a fantastic property, but you know, property is essentially a very illiquid asset. You bought the house, but let's say you have some emergency, you might not be able to sell it off very easily. You need the money, let's say in a month's time. Property may not be able to dispose at the rates that you expect in a month's time. So that is something that you really need to understand in terms of liquidity, right? And in terms of the time horizon also, you need to understand, let's say especially when you look at the retirement. If you have options like investing in 30-year bonds or a 20-year bonds, obviously you know that you're locking in that money over a 20 or a 30-year period. So then that's also like another important question that you need to ask. I mean, you're not going to invest in a 20-30-year investment when you're at 55, right? But at the age of, let's say, 25 to 30, you can take that horizon because you still will be able to do some work over the period of the time. And then I think one of the more important things is that Lakshmi also touched it was like on in terms of corporate governance. I think she touched the more unregulated type of financial institutions. But when you give money or invest in a project, I think this is very critical, looking evaluating the management style and whether there is proper credible management running the company, and is that the company that you're giving money. So I think Lakshmi also elaborated that we need to pick the right type of investment advisor. So similarly, I think that corporate governance as to the financial institution that you're giving money is actually sort of really good. And if you come into like the more money market funds, I think though they are, I mean, when I look at like broadly the unit trust or the mutual trust, the broad spectrum there, like what is being hottest, the most hot selling product is the money market product, right? So essentially that again is a very short term product, right? But there is longer tenor products, there are high risk products, but people don't really look at it. They also go for the plain product. So when you especially look at like a unit trust, you should risk that the unit trust company, management company is taking, and in terms of there are charges involved. So what type of charges are, your return is after charges or before charges. So I think those type of basic understanding you really need to pose in terms of questions efficiency, right? So taxation is also another important element in financial planning. Come up with instruments that are more tax efficient. For example, if you come to invest in equity in Sri Lanka, capital gains are tax free, right? And there is some allowance if in case you invest in equity securities. Not only equity securities, I mean there are some asset classes up to 1.2 million. Those are allowable expenses in terms of tax, or you can have tax savings. So in terms of taxation also, you can pose those questions in terms of how the taxation is going to work. So I mean, if in case you say you get 5% on a 1-year deposit, you also have to factor in that you have to pay tax on this return, right? So effectively you're not going to get 5%. So that's also another important thing of financial literacy that you look at in order to make sure that you get optimal returns. I don't know whether I was a little too technical, but these are like some of the areas that I wanted to touch, and that we need some amount of knowledge so that we ask the right questions for the betterment of us.
No, I think that's completely fine, Bimanee. I think we have time for one question before we kind of wrap up. This was a common question we kind of got from a few people, but in terms of the current pandemic and the low interest environment, what type of investments would you recommend?
Okay, I'll take that on first, right? I think Bimanee mentioned this before, right? If you have not locked in your fixed deposits for longer than 1 year, do not look at fixed deposits because it's giving you 5 to 5.5%, whereas inflation is much higher than that, right? So think about some other alternates as well, which does not mean at all that you put all your money into one basket, right? You've got alternate assets. You've got the equity market, which at this point of time is a good entry point as well. The market actually was up quite a bit, and now it's come down because of the second wave fears. And again, it's not every single stock that you need to look at. You have to look at very solid. There's something called the S&P SL20, which has the most liquid stocks. If someone is risk averse, I would advise them to look at the S&P SL20. There are some other stocks as well that have a very good entry point at this time. If anyone is interested, I would advise them to go to a reputed investment advisor, a reputed company, and maybe ask a couple more questions about it. So the stock market at this point is a very valid place, right? If you have more than if you have quite a bit of funds that are lying around, or if you have a very big fixed deposit, for example, that's maturing, I would say real estate again is a very good place to look at because real estate keeps appreciating. It's a very solid investment, and it's something that has been looked at because if you do your research on it. But what you have seen is that since interest rates declined in Sri Lanka, you've seen real estate prices going up marginally because the demand has picked up. And we've spoken to a couple of these big tier real estate companies, and they're saying the demand for real estate has picked up more than double because people are looking at solid places to park their investments. And if you are risk averse even more, you've got options like positioning yourself into debentures. You have options like that. I wouldn't say fixed deposits are the best at this point. I wouldn't say money markets are the best at this point. Again, because rates are so low, but you do have alternate areas. To me, the big three at this point are the equity market, real estate, and debentures. Debentures are again in A-listed companies or big, very good rated companies.
Yeah, so obviously we all know that it's historically low interest rates that we are facing. So especially for borrowers, this is going to be fantastic time. So this we spoke when we started also. So that can be like another element that you can look at it. You can gear yourself up for new sort of ventures if in case you are sure of taking on some debt and making sure that you can make some higher yielding property or assets or businesses surrounding. I think that's like one of the areas. So stock market has been like one of the most commonly spoken of area. So because Lakshmi elaborate on the stocks, I'm not going to touch upon it a lot over there, but I think like what I would want to impress upon here is that like our society is essentially a 3-6-1 year type of fixed deposit society. So I think when interest rates do pick up, okay, so it will pick up at some point. So you have to take like you have to expand your horizon, maybe 5 years, 10 years, 15 years, because there are, of course, in terms of fixed deposits, there are fixed deposits up to 5 years, right? And there are government may issue bonds even up to 30 years, right? And then corporates like debentures, generally up to about 15 years is where you can invest, right? So for rainy days, I would really urge that people look at more longer term investments, even in the fixed income market. Look at more longer durations so that you don't simply complain when interest rates come down. For example, let's say a pensioner who was living, let's say, on a 10 million deposit, okay, and if in case they got a 10% rate, so that means they got 1 million. But right now, with interest rates coming to 5%, your income from 1 million has halved to 500,000. Let's say if in case you have to manage your medical expenses and other utility bills, it's going to be a very tough task, right? But if in case you had some amount of money invested in a 5-year at higher rates, when the rates were high, I think, I mean, you would have got some income at higher rates. I mean, that also you can lock in a way, like you can do a 5-year fixed deposit with monthly interest coming in, right? So there is some, even if rates come down, you will still get paid at, let's say, 10 or 12%, which you invested a year back. So that's going to be fantastic. So debentures, Lakshmi spoke about, and I think property, real estate, I think it will never go out of fashion in South Asian economies like us. So I think that's like going to be fantastic wherever you buy. I mean, of course, maybe like if in case you really pick and choose where you buy, I think again exponential growth can be looked at. I think one of the other things that commonly which will be looked at in Sri Lanka is gold. So I think gold also has done like a fantastic I mean, the gold also has done like some fantastic return. And the other thing is if in case you have foreign currency coming in, I would really look at and encourage foreign currency deposits and maintaining dollar-based sort of income, which is obviously going to be quite good. So essentially, every opportunity, every situation creates an opportunity. So right now, like what I said, because it's interest rates, so obviously, yes, you have to manage your investments, but also this is essentially a borrower's market these days.
Can I also just add one more thing though, please, right? I think if there is anyone who's got a significant amount of debt at this point of time, I think these low rates are also very beneficial because you need to ask your bank how you can restructure your debt, right? Essentially pay off your old debt and restructure so that you get into your loan, for example, at these rates. I know a lot of people have done this, and it is something that I think is the most useful thing to do in this kind of environment. If you have a lot of loans that you're paying 16, 17%, which was the rate about 5 years ago, look at ways how you can restructure this, right? Look at ways how you can maybe take a new loan, pay off that old loan, finish that off, and start your loan at 9%. If you paid 16% earlier, you're just paying 9% now. I think that is one of the key things you can do at this point of time.
Thank you, Lakshini, and thank you, Bimanee. Thank you so much for taking the time to be here today and share all your insights and experience with our viewers. Thank you to everyone who tuned in today to catch us on this episode. Thank you to our sponsor, NESCAFÉ Gold, and see you soon.
Thank you.
Thank you. Bye.